Hey everybody, welcome back to episode number 4 of Fitness and Money, Maximizing Your Health and Wealth. During the first 3 episodes, we chose to do back. For obvious reasons, people have a lot of back issues. You need to have a strong back both when you're younger and as you get older. We did emphasize form. We went through 3 different exercises for different parts of the back. And again, throughout these videos, we're going to keep emphasizing form when we do these exercises, only because, like I said in previous videos, we see a lot of people at gyms or wherever they're working out, and we see them using improper form, which can lead to using stabler muscles, which means you're not really exercising the muscle that you want to, or you can make yourself prone to injury, and we certainly don't want to do that. So starting this week, we're going to do chest because we do want to balance the back muscle with the chest muscles. We need to be able to have that balance front and back in order to have both a good solid back and a good solid front. Also, it'll help the core muscles. It'll help with, we all do this with our phones and whatnot. So it's good to balance those muscles out. So without further ado, today we're gonna do probably my favorite chest exercise, and those are flat bench flies. A lot of people dismiss flies because they immediately think it's an isolation exercise, which I'm not going to disagree with that. It pretty much isolates your chest muscles. You're not, a lot of the exercises that you'll see people doing and that we might be doing for chest use triceps. And again, similar to when we were doing back exercises with doing them a particular way, we wanted to mitigate the bicep muscle from giving out first. Same thing with chest. We want to minimize the tricep muscle so that we can get our chest worked. Flat bench flies are one of the best ways to do that. People, again, I'm going to show you all these exercises the way that people do them wrong, and then I'm going to show how you can do them right to get the most from the exercise. And again, we're not going to concentrate on the amount of weight you're using. We're going to emphasize form over the amount of weight. To be quite honest with you, your muscle, as long as it's getting thoroughly worked, your muscle doesn't completely recognize whether you're using 80 pounds or whether you're using 30 pounds. As long as you work that muscle almost to the point where you can't do another rep, that's pretty much what you want to do. Also, speaking of repetitions, and I may not have covered this before, we don't want to do anything lower than 6 repetitions, and we don't want to do anything higher than 12 repetitions. If we're doing more than 12 repetitions, you're going to want to increase your weight to bring you probably back down in that optimal range, which would be, say, 8 to 10 repetitions. If you're unable to do 6 repetitions, you're probably going to want to lower your weight so that you can get back into that, again, optimal range of 8 to 10 repetitions. So without further ado, we're going to grab what I'm going to do here is I've got a set of dumbbells right here beside me, and I'm going to show you the incorrect form to use first, and then I'll show you the correct form. So I'm going to have to turn around for this to be able to show you kind of the right way here. So I'm going to sit down on the bench. I'm going to lay flat, and I'm going to grab the dumbbells, and I'm going to bring them up. So what we don't want to do when we're doing this exercise is we don't want to be doing this, we don't want to be doing this, and we do not want to be raising our butt off of the bench. Those are all things that will not help doing the exercise correctly. The other thing, as I start doing the exercise, is we don't want to be doing this. Even if we have the dumbbells positioned correctly, we don't want to be doing this. It kind of turns into a kind of a press, and we don't want to be doing a press. So the right way to do this exercise is dumbbells right above your chest line, and I want you to envision that you are hugging an elephant. As you come out, I want you to come all the way out here and bring the weights back up here. All the way down and bring the weights back up here. All the way down, bring the weights back up here. That's going to be the optimal form. And again, I want you to keep that analogy in mind of hugging an elephant. We don't want to be in here when we're doing the exercise. We want to be out here. The other important thing is we don't want our elbows straight. That's absolutely going to induce injury. We want to keep the elbows, as we're doing these on the bench, slightly bent. Kind of just like that. We'll go back and we're going to do this without the dumbbells, but I'm going to show you, you don't want to do this. This is not good for your elbows. This is going to lead to injury. You also don't want to come down here. You want to keep about equal with the plane of your body, which is hopefully somewhere where I am right now. And again, you want to keep your elbows bent like this. And as you come back up, that's the right motion for the exercise. And again, it's going to be like you're hugging, picture yourself hugging an elephant. You want to be out as far as you can. Okay, so that is flat bench flies. We're going to go over these all again because I know I'm doing it really quickly and I'm trying to explain the good form versus bad form. There's a lot of little things that can be done to optimize the exercise, but I'm hitting the big ones that you don't want to do, and then I'm hitting the right way to do it. So now let's transition over to kind of a succession financially of what we were talking about in the first three. I'll give you a little summary of what we were talking about in the first three episodes. So as I said initially, wealth is something that is created by keeping more money than you make. It's not what you make, it's what you ultimately keep. Big salaries do not equal wealth. If everyone is spending those big salaries, they're not accumulating wealth. Ultimately, what you want to do is be able to live off the income of your investments. And maybe some of you are lucky enough to have pensions. Maybe some of you are lucky enough to have rental property income. That's what they call passive income. And when you live off of your investments, that can also be passive income. So what we covered in episode number 1 was paying yourself first. You want to make it automatic. You want to go to your employer's plan. You want to go to your bank or go to your financial institution that you're most familiar with, and you want to automatically have a certain amount of money withheld from your paycheck whenever you get paid, whether it's weekly, bi-weekly, monthly, whatever it might be. That's going to be key to be able to building wealth. Then we started talking about different plans, 401ks, Roths, the difference between some of those, traditional 401ks and traditional IRAs are deferred compensation, which means the money that comes right out of your gross income, whereas Roth IRAs or Roth 401ks, that money that gets saved or invested is going to come out of your net income. There is a difference. We'll go into that in more detail. But what I wanted to cover today was the types of investments that you can put your money into. So right now, as I alluded to in previous episodes, inflation, the cost of goods, is very high. We all know that. We go to the grocery store, we go to the gas pump, we look for products, and the prices are far outpacing anything that we've seen in the past 40 years or so. So to try to compensate or mitigate inflation, we have to have products that are going to at least try to keep pace with inflation and not lose money. Because if you think about it, if you keep your money in just a traditional savings account or a checking account at your bank, or if you keep it locked up in your safe in your house, it's earning 0% interest, which when inflation is going up at rates of 5, 6, 7, 8%, you're essentially losing money. Your money that you have sitting under your mattress or in a safe or in a savings account has less buying power than it did previously. That's what we don't want to do. So my recommendations would be to get with your financial institution. I happen to use a brokerage account called TD Ameritrade. There's also E-Trade. There's many different online services. I would stick with the big ones. There's Vanguard, there's Fidelity, there's TD Ameritrade, there's E-Trade. TD Ameritrade, by the way, is going to be Schwab fairly soon, just so you recognize that name. And what you're going to want to do is you're going to want to just start doing a little bit of research. There's many, many different vehicles that you can invest your money in at any given point in time. Most people invest their money in mutual funds. Mutual funds are really, if you think of investing in a single stock, so let's pick a single stock like Lockheed Martin, biggest defense contractor in the country. You could invest in that one particular stock. However, your risk is going to be more on the outer scale of risk in terms of, if that stock goes up or down, you don't want everything being based on the price of that stock. So what happens is you put your money in a mutual fund or perhaps a couple of different mutual funds. And what those mutual funds do is they might invest in anywhere from 30, 50, 70, 100, even more stocks. So what happens is, as certain stocks in the portfolio go up, there are other stocks that are going to remain neutral and perhaps some that are going to go down. So your upside potential is perhaps capped a little bit. Your downside potential of losing money is probably also capped to some degree, and you're kind of mitigating that risk. If you look at a risk spectrum here, if you buy an individual stock like Lockheed Martin and you're out here on the risk spectrum, if that stock goes up or down, you could lose some very significant money. Whereas if you're in a mutual fund, you're going to kind of oscillate back and forth in this range. Might go down a bit, maybe neutral, maybe up. But over the long term, your money is going to grow. And I just want to cover stock mutual funds at this point. And again, there's many of them. I'm not going to make any specific recommendations, but you can get into these stock mutual funds, and you should be able to do it through your bank or through whatever financial institution, credit union, and again, any of these online brokerages. So I want to leave you with one analogy that when you think about it, I want you to visualize it or even draw it out. And this is kind of the way the stock market goes. And right now is actually a really, really good time for that analogy, because 2022, here we are at the beginning of May of 2022, and stocks are not doing well. Stocks have gone down. It's been almost indiscriminate. I will talk about sectors next time in terms of different sectors that you can invest in so that you can try to mute some of the downside and perhaps take advantage of some of the upside. But I want you to picture a boy or girl walking up a gradual incline. So let's picture them walking up a hill. They start at the bottom of the hill and they start walking up. That incline, however so gradual, they are always going up. Then I want to picture that boy or girl, woman or man, with a yo-yo in their hand, and they're flicking that yo-yo up and down, as they're walking up that hill. When the yo-yo goes down, that is the down cycles in a market. And we will talk about corrections. We will talk about bear markets. We're certainly in a correction now and perhaps approaching a bear market, at least in some of the different indices in the stock market, and we'll talk about those too. So I want you to picture that woman, man, boy, girl walking up that hill very slowly with the yo-yo going down and up, down and up. Right now, that yo-yo is on the way down as that person is walking up the hill. That yo-yo will come back up at some point. The boy, the girl is still walking up the hill. So I guess what I'm trying to get at is look at the yo-yo as the month-to-month, perhaps even year-to-year inflections that happen in the stock market, with the way that it will go like this. However, the trajectory of that individual walking up the hill is always steadily going up. That's a stock market. In order to build wealth, you have to have your money in investments that are going to make money for you over the long term. And what I'm talking about long term, you can't get caught up looking at day-to-day, week-to-week, month-to-month things that are happening in the stock market. Now I do, because I'm a little bit more in tune and a little bit more heavily invested, and I do, certainly not a day trader, and we'll go over what that means as well. But I do like to make strategic moves with my portfolio so that we can maximize some sectors that are doing well and minimize sectors that are not doing well. So I just want you to keep that analogy in mind. Over the long haul, the stock market always goes up. We'll talk about things like time horizon and expectations and the rule of 72. When I talk about the rule of 72, that's going to get you really excited because you're going to see how quickly money can double. And that's what we call compounding of money. And it really is quite fascinating when you see it in action. So that's it for today. I appreciate you tuning in. Again, if you're getting any value out of this, I hope you are. Again, we're starting out at the very, very base bottom floor, and we're going to start to continue to build as concepts become more easily understood for us. We're going to get into more moderate and maybe even some complex things relative to both fitness and financial investing to help build your wealth. So I appreciate you tuning in today, and if you like it, hit the like button, subscribe, and we'll see you next time. Thanks.